We're diving into a hot topic that has everyone in the industry talking. According to well-known investor Michael Burry, the recent stock market surge may just be an elaborate hoax. That's right, the man behind the hedge fund Scion Asset Management and inspiration behind the hit film The Big Short seems to believe that the current market upswing won't persist. As investors, we know that every word from Burry carries weight, and his stock portfolio is closely examined to figure out which firms he trusts and which he doesn't. With so much uncertainty in the market, people are eagerly awaiting Burry's thoughts on whether or not a harsh landing, such as a recession, is imminent, or if the Federal Reserve can effect a gentle landing. Stay tuned as we break down this intriguing development and what it could mean for your investments. A crazy ride. As the year begins, the stock market is on the rise with the S&P 500 climbing 4.6% to reach an impressive level of 4,016.95. This surge in investor confidence is due to the belief that if consumer prices decrease, central banks will be less likely to raise interest rates, potentially avoiding a full-scale economic collapse. However, not all market experts share this optimism. One notable dissenter is the renowned investor Burry, who suggests that the market's current success may be nothing more than an illusion. In a tweet on January 23rd, he shared a graph of the S&P 500 from 2000 to 2003, highlighting the period between September 2001 and April 2002. This timeframe includes both the dot-com boom and the aftermath of 9/11, during which the market reached a state of relative stability before ultimately plummeting. Burry's tweet, paired with his previous prediction of a recession in the second half of 2023, suggests that he believes the market is headed for a similar downfall. Additionally, Burry notes that the IT sector, despite the overall market increase, is still shedding a large number of jobs. Data firm Layoffs reports that IT businesses have eliminated over 58,000 positions in 2018 alone. This, coupled with the Federal Reserve's increasing interest rates since the 2008 financial crisis, paints a bleak picture for the economy's future. Burry, who gained legendary status following his successful prediction of the 2008 financial crisis, remains a role model for those looking to challenge conventional wisdom in the financial world. As we enter the year, it's worth considering his warnings and keeping an eye on the potential red flags in the market. A legendary warning. The 2015 film The Big Short highlighted the dangers of the subprime mortgage industry and the potential for a collapse. One investor, Michael Burry, saw through the facade and correctly predicted the downfall, earning himself a reputation as a Wall Street prophet. Fast forward to 2022, Burry's predictions of a worsening economy, widespread layoffs, and a stock market moment of truth have all come true. This time, it's the public equities markets that are experiencing volatility thanks in part to the rise of passive investment vehicles and the incorrect application of the efficient market hypotheses. In September 2021, Burry brought attention to a scholarly study titled In Search of the Origins of Financial Fluctuations, the Inelastic Markets Hypothesis, authored by researchers from Harvard and Chicago. The study analyzed stock market shifts from both a theoretical and an empirical standpoint and uncovered four major issues: a lack of funds, households being limited by regulations, the lack of flexibility in passive investing options, and limits on a fund's flexibility, even with a seemingly modest mandate to invest in equities. This research has far-reaching implications for the global financial system and highlights the importance of considering both theory and empirical evidence when analyzing market shifts. As Burry's previous track record shows, it's crucial to be aware of the potential dangers and be willing to short the market before it's too late. In today's fast-paced and ever-changing financial market, the role of arbitrators can be crucial in maintaining balance and stability. However, despite the importance of hedge funds in this process, recent research has shown that they only make up a small portion of the market, at just 5%. This is a cause of concern, as hedge funds are known to be vulnerable to large losses during bear markets and have limited capacity for risk. Furthermore, the market elasticity of hedge funds is often small or even negative, meaning that they are not able to effectively transfer risk from one set of investors to another. Despite the common belief in the efficient market hypotheses, which holds that the market is always functioning optimally, this is not always the case. The events of 2008 and the GameStop controversy of 2011 have shown that markets are not always reliable and that individuals can undergo drastic transformations. As a result, it is important for economists and financiers to reevaluate their beliefs and consider the limitations of the efficient market hypotheses. As Michael Burry, a renowned financial expert, stated in his graduation speech at UCLA, the knowledge we have at our disposal is imperfect. The risk isn't always associated with volatility, that markets aren't always reliable, and that individuals may undergo transformations. It is time to move beyond the financial dark ages and embrace a more nuanced understanding of the market. A overpriced market. Stable markets have always been a topic of interest for economists, but recent findings have shown that the efficient market hypotheses models used by orthodox economists may be inaccurate by 100 times. The macro elasticity, which is the measure of how sensitive the stock market is to price movements, was originally thought to be 20, but new studies have shown that it is closer to 0.2. This means that the stock market's overall demand is relatively insensitive to price movements, and that it is mostly driven by the inflow and outflow of capital. This has significant implications for the stock market, as at least 30% of stock market fluctuations may be attributed to these flows. This could explain the cyclical nature of the performance of some mutual funds and companies like ARK Invest, Tesla, GameStop, and Bill Hwang's Archegos. It also means that buybacks, which have no effect on stock prices in the classic finance model, may have a significant impact on stock prices in an inelastic environment. Investing an additional $1 in the stock market can increase the market's overall worth by $5. This 5-to-1 ratio may seem more absurd as time goes on, especially with 90% of millennials already invested in passive market vehicles. The research also looked at the economic downturn that occurred from 2000 to 2002 and found that the largest market was actually homes, with only 0.5% being sold each quarter. This highlights the importance of understanding the true nature of the stock market and its underlying factors in order to make informed investment decisions. As the economy continues to shift and evolve, it's important to take a closer look at the factors that influence price changes and the erosion of value. According to recent research, there is a positive association between flows and these factors, with the two being mean reverting. This association was on full display in 2008 as both households and businesses saw small increases in sales, while exchange-traded funds, ETFs, and pension funds continued to purchase. The use of quantitative easing in equities, similar to bonds, has also been explored in less flexible markets. In the past, government intervention in the form of purchasing stocks in China and Japan led to a significant increase in prices, with a nearly 1-to-5 ratio. This further highlights the extreme volatility of the market and raises questions about the reasons behind such common profit price movements and lack of liquid assets. An imminent recession. As we move into the future, it's important to keep an eye on economic developments and predictions. For example, investor Michael Burry recently predicted a recession for the U.S. economy in 2023, along with a fresh wave of inflation. His past forecasts have proven to be accurate, and he believes that inflation has peaked, but that this is not the final high point of the cycle. By the second half of 2023, the Consumer Price Index, CPI, may have fallen to negative territory, and the United States will be in recession. The current inflation rate in the United States is also a concern, with rates reaching 9.1% in June and remaining over 7% through November, both new record highs. The U.S. Federal Reserve has set its inflation target at 2%. Thus, this is far higher than that. The central bank then increased the basic interest rate from near zero to over 4%, forecasting that it would reach over 5% by 2023. As we navigate these complex economic issues, it's essential to consider the potential risks and benefits of different policy choices. An increase in interest rates may help ease inflationary pressures, but it also carries the risk of lowering corporate profitability, slowing economic development, and triggering a decline in asset values and a recession. As 2023 approaches, renowned investor Michael Burry warns of deflation and a struggling economy on the horizon. In response, the Federal Reserve is expected to lower interest rates, and the government will ramp up spending in an effort to stimulate growth. However, this influx of demand could also lead to a rise in inflation. Burry, who made a name for himself by correctly predicting the housing market crash in the mid-2000s, has recently made headlines for his investments in GameStop and his warnings of a speculative bubble in meme stocks and cryptocurrency. The man behind The Big Short book and film, Burry has a history of making bold moves, such as his $1 billion bet on the housing market and his short position on Tesla and ARK Innovation. As the world watches to see if Burry's predictions come true, one thing is certain: he's a force to be reckoned with in the world of finance. Don't miss out on the latest financial insights and strategies. Be sure to subscribe to our channel, like this video, and stay tuned for more informative content on the economy and investing.